Your monthly premium pays for a legally binding contract of utmost good faith. This document is the primary tool used to transfer catastrophic financial risk away from yourself. Vehicles weigh thousands of pounds and move at high speeds. One mistake on a crowded road creates immediate, severe physical and financial damage. To legally drive, every state requires you to buy a minimum amount of liability coverage. Most drivers choose these lowest allowed limits simply to keep their monthly bills down. But those minimum limits almost never cover the actual cost of a modern collision. If you cause a crash, whatever your insurance doesn't pay becomes your personal legal debt. This auto insurance risk matrix plots monthly premium costs against out-of-pocket risk. State minimums lock in the lowest premium, but you absorb massive personal financial risk. Because hospital stays or replacing a new car easily exceed basic limits, your true out-of-pocket risk is staggering. Treating the bare minimum as a safety net is a financial illusion. Protecting yourself requires balancing premium costs without absorbing the risk of total financial ruin. After a crash, your financial recovery strategy is entirely dictated by state law, which overrides any general insurance advice you might read online. This flowchart illustrates the fault system. You prove liability to get their insurance payout. This allows lawsuits, but introduces delays while investigators argue. The no-fault alternative lets you bypass the other driver and file directly with your own insurance. No-fault states require personal injury protection, or PIP. This mandatory coverage pays medical bills and lost wages instantly. The trade-off is the state restricts you from suing the at-fault driver for pain and suffering, unless injuries meet a severe threshold. If you collide in an intersection where the right-of-way is disputed, a fault system might leave you waiting months for a settlement, while a no-fault system pays your hospital bill immediately. Knowing your exact state legal framework is the absolute prerequisite to choosing the right coverage priorities. This graphic shows how third-party liability limits are written out. A sequence like 25, 50, and 25 represents the absolute mathematical ceiling your insurer will pay for a single person's injuries, total injuries in the accident, and property damage. That final number is your specific limit for property damage liability. If your policy has a $25,000 limit and you total an $80,000 pickup truck, your insurance stops paying at $25,000. That leaves a $55,000 gap the insurer won't cover, becoming your personal debt. The same math applies to bodily injury. A $50,000 total limit is completely wiped out if one injured passenger requires a $150,000 spinal fusion surgery. And keep in mind, third-party liability coverage provides zero financial protection for the physical damage to your own vehicle. To cover your own car, you need collision coverage. You can lower your monthly premium by raising your deductible from $250 to $1,000, but you must keep that cash liquid in a bank account for emergencies. Opting for cheap premiums by choosing low liability limits mathematically shifts the risk of catastrophic debt directly onto your personal net worth. Your insurance contract also contains strict policy exclusions. These are hard boundaries where the insurer owes you absolutely nothing. This table from the research data shows how severe infractions skyrocket your costs. A DUI increases your premium by an average of 79%, creating a strong financial motive to hide high-risk household members from your insurer. Leaving a teen driver or second vehicle off your policy is an owned but unlisted exclusion. It saves money up front, but explicitly breaches your contract. Withholding that information violates the foundational principle of utmost good faith. As a result, the insurer has legal grounds to retroactively void your entire policy. If that unlisted teen causes a crash, you are fully liable for all damages out of pocket. Another major trap for modern drivers is the business use exclusion. If you use your personal car to drive for Uber or Lyft without buying a specific commercial endorsement, your personal policy turns off the second you log into the app. If you breach the contract terms, full coverage is an illusion. Total honesty with your insurer is the only strategy to ensure your claims are actually paid. This table is a policy optimization map. It matches specific risk profiles with optimal coverage strategies. The first profile is the budget optimizer, someone with low personal assets and a very tight monthly budget. If this is you, buy liability limits higher than the state minimums, but offset the cost of that coverage by raising your collision and comprehensive deductibles as high as possible. The trade-off here is straightforward. You prevent life-ruining litigation debt, but must maintain a small cash emergency fund to cover your own vehicle repairs. The second profile is the asset protector. These are homeowners, high-income earners, or parents with teen drivers. This profile should maximize bodily injury and property limits, up to $250, $500, and $100, and aggressively add uninsured motorist coverage. These elevated limits protect your high-value personal assets and your future wages from being seized in a lawsuit. You accept higher monthly premiums in exchange for aggressively shielding your net worth. Finally, the no-fault resident. In a no-fault state, maximize your PIP coverage for an instant safety net for medical care and wage loss post-crash. Auto insurance is a highly customizable financial shield. It requires active architecture to protect your specific financial future.